The financial markets don't just take your money. They set traps. And the cruel part? You walk right into them. Not because you're stupid, not because you lack charts, but because the market knows exactly how to manipulate human psychology. It's the same story every day. Millions of traders logging in, convinced they're ready this time, only to be ambushed again. Let me ask you, have you ever chased a breakout only to realize volume was pathetic and the trend collapsed in your face? Have you ever watched your stop loss get wicked out just to see the market reverse immediately afterward? Have you ever jumped into a trade because you were bored or had a feeling only to regret it seconds later? Or maybe you've trusted an RSI divergence like it was gospel, only to find yourself holding the bag as the market laughed at you. Here's the truth nobody likes to admit. Even veteran traders fall into these traps. It's not about intelligence. It's about wiring. The market exploits fear, greed, and impatience better than any casino ever could. And unless you see the traps clearly, you'll keep feeding the machine. Over the next parts, I'll expose the 4 most common traps that bleed traders dry: ignoring volume, getting hunted by whales, trading impulsively without a plan, and misreading indicators. Not just what they are, but why they work, how the pros avoid them, and how you can flip them into an edge. So before you place your next order, stay with me. Because the difference between bleeding and surviving isn't just your strategy, it's spotting the traps before they snap shut. And that takes us straight into the first one, the seductive breakout that almost always betrays you. Let's talk about the first trap, the seductive breakout. You've seen it. A chart coils tight, price builds pressure, and suddenly, bam, a green candle rockets through resistance. Your heart pounds. This is it, you whisper, clicking buy with conviction. For a brief second, you feel like a genius. And then, just as fast as it surged, the breakout dies. The candle flips red. The market laughs as you watch your equity vanish. Welcome to the graveyard of low-volume breakouts. Here's the harsh truth. Not every breakout is real. In fact, most breakouts fail. And the common denominator? Low volume. Yet traders ignore it every single day. They stare at price as if it's gospel and completely forget the second half of the equation: participation. Price without volume is just theater. It's smoke and mirrors designed to lure in the unsuspecting. Think about it. Would you trust a restaurant that looks busy from the outside but is empty when you walk in? That's a low-volume breakout. The facade looks impressive, but the substance is missing. Professionals know this. They watch the order flow, the tape, the participation. Amateurs? They see a candle and call it destiny. Why does this happen? Psychology. FOMO, fear of missing out, is the most addictive drug in the markets. A candle breaks resistance, and suddenly your brain screams, "I'll miss it if I don't act now." Never mind that volume is whispering. Relax. Nobody's behind this move. Never mind that the so-called breakout is being driven by a handful of orders. The crowd doesn't hear whispers. They hear fireworks. And they chase. Volume is confirmation. It's the lie detector test of price action. A breakout with heavy participation means the crowd is committed, liquidity is flowing, and the move has legs. A breakout on low volume, that's a hollow promise. It's a trap door, not a launch pad. And here's the kicker. The market wants you to believe it. That's why it paints big green candles without substance. Because it knows you'll bite. Let me give you an example. Suppose Bitcoin is consolidating at $40,000. Suddenly it jumps to $40,800 in a single candle. Retail goes wild. Twitter screams, "Breakout confirmed," but volume is thin. The pros? They're not buying. They're waiting, because they know what comes next. Price collapses back under $40,000. Retail panics and smart money scoops up liquidity at a discount. The breakout wasn't a breakout. It was a liquidity grab, fueled by the impatience of traders who never learned to ask the one simple question: where's the volume? So how do you defend yourself? First, stop treating every breakout like a lottery ticket. Before you click buy, check the fuel behind the fire. Look at relative volume, compare it to average levels, and ask, is this move supported or is it just noise? A strong breakout should feel like a wave, undeniable, overwhelming, impossible to resist. A weak breakout feels like a ripple. Learn to feel the difference. Second, use tools. Volume profile, OBV, on-balance volume, VWAP deviations. They're not just technical toys, they're filters against traps. If volume doesn't confirm the price move, treat it as guilty until proven innocent. Third, embrace patience. This is the part nobody wants to hear. Real breakouts don't vanish in seconds. If the move is real, you'll have time to confirm it. If you feel like you have to act instantly, that's not edge. That's addiction. Professionals wait for retests, consolidations, second chances. Amateurs chase the first flash and get slaughtered. Now, let's add a dose of sarcasm. If you love donating money, by all means, keep buying every candle that pokes above resistance without checking volume. Think of it as your contribution to the Market Whale Charity Fund. They thank you for your generosity. But if you're tired of being the victim, start treating volume as the gatekeeper of truth. No volume, no conviction. No conviction, no trade. Simple as that. Here's the motivational angle. Discipline isn't glamorous. Nobody brags about not taking a trade on social media. But the ones who skip the trap trades are the ones still alive 5 years from now. Survival is built on the trades you don't take just as much as the ones you do. That's what separates the amateurs who flame out from the legends who endure. So the next time you see price rip through resistance, pause. Ask yourself, do I see real participation, or am I falling for a magic trick? Because in this market, impatience is a death sentence. But patience is a superpower. And just when you think you've dodged the breakout trap, another predator lies in wait. This time it's not about low volume. It's about predators hunting your stops, deliberately forcing you out before the real move begins. Welcome to Trap 2. Stop hunts. Now let's pull back the curtain on one of the dirtiest tricks in the entire financial market. Stop hunts. If you've ever placed a stop loss just below support, felt safe, and then watched the market slice through your stop, only to rebound immediately after, you've been hunted. Welcome to the slaughterhouse. Here's the brutal truth. Your stop loss is not a secret. You think you're clever hiding it just below a round number? Congratulations. You've placed it in the exact spot where thousands of others have too. Big players, hedge funds, market makers, liquidity providers, they know this, and they feast on it. They deliberately push price into those pools of stops, trigger your panic, scoop up your liquidation, and then ride the real move without you. You're not unlucky, you're bait. Think about it. The market is not some abstract force, it's a battlefield. And on this battlefield, liquidity is the ammunition. Big players can't move size unless they take yours. Your stop loss isn't just protection, it's supply, it's fuel. And the professionals know exactly where the gas tanks are buried. Picture this. EUR/USD is consolidating, building tension under resistance. You go long, set your stop just under the nearest swing low. The market dips, tags your stop perfectly, then rockets back up in the direction you originally predicted. You stare in disbelief, cursing the manipulation. But was it manipulation? Or just your own predictability? Here's the sarcastic reality. Retail traders love being predictable. They place stops at round numbers, at textbook support, at obvious Fibonacci retracements. It's like painting a giant red X on your forehead and asking, "Please hunt me." The whales don't even need to guess. They just sweep the order book and collect. Now, let's break it down technically. A stop hunt occurs because big players need liquidity. Imagine trying to buy 10,000 contracts. You can't do that in a dry market. You'll move price against yourself. So what do? You drive price down into a zone where thousands of retail stops are waiting. Their forced selling provides the liquidity you need to buy. Once you've filled, you let price rise. Retail is out, smart money is in. Game over. So how do you defend yourself? First, stop being obvious. If your stop is sitting at the exact level everyone else can see on a YouTube tutorial, you're roadkill. Professionals place stops wider, less obvious, or better yet, They size down so they can mentally tolerate volatility without tight stop losses. Risk management isn't just about placing a stop. It's about placing it where the crowd isn't. Second, learn to read liquidity. Tools like volume profile, order flow, and liquidity heat maps aren't toys. They're X-ray glasses. They show you where the clusters of stops are likely sitting. If you see a juicy liquidity pool just under support, you should assume it's a target, not a safe zone, a bullseye. Third, flip the trap. Instead of being hunted, hunt with them. If you know stops are sitting under a low, wait for the sweep. Watch price dip, trigger the panic, then look for the recovery. That's where the real move begins. Smart traders don't avoid stop hunts. They exploit them. But let's step back into psychology. Why do traders keep falling for this? Because they crave certainty. They think, if I put my stop here, I'm safe. But safety doesn't exist in the market. The market is designed to attack certainty. Your need for safety is the very weakness being exploited. The real skill is not placing the perfect stop. It's managing size so that no stop can ever kill you. It's shifting from, how do I avoid pain, to how do I survive pain? Here's the motivational punch. The stop hunt isn't your enemy, it's your teacher. Every time you get wicked out, you're being reminded the market rewards patience, not predictability. It rewards resilience, not ego. And if you can learn to stop whining about manipulation and start adapting, you turn the game in your favor. So the next time your stop gets hit perfectly before price moves your way, don't rage quit. Ask yourself, did I place my stop where the crowd did? Did I size too big, forcing myself into a vulnerable position? Or did I ignore the liquidity map and walk straight into a slaughterhouse? Those answers will tell you if you're growing, or just repeating the same donation ritual. And here's the final twist. Stop hunts aren't the only trap that bleed traders. Sometimes you don't even need whales to kill you. You do it to yourself. Because what's more dangerous than being hunted? Hunting yourself with impulsive trades. No plan, no discipline, no framework. That's where we're heading next. Welcome to Trap 3, Trading Without a Plan. Let's be honest, most traders don't lose money because of the whales or manipulation. They lose because they walk into the market with no plan, no rules, no structure, just vibes. It's financial Russian roulette dressed up as ambition. You know the story. You open the chart, maybe sip some coffee, scroll through time frames. Nothing special is happening, but your brain whispers, click something. Why? Because boredom is unbearable. You came to trade, not to wait. So you click buy, click sell, doesn't matter. It's the illusion of action. For a moment, the dopamine hits. You feel alive. Until the market reminds you, it doesn't pay dopamine, it charges for it. This is the third trap. Impulsive trading without a plan. It's not glamorous, but it's deadly. More accounts are destroyed by boredom trades than by any macro event. And the saddest part? The traders doing it know better, even veterans. They'll admit, yeah, I shouldn't have entered that, after the loss. But in the moment, they can't resist. The screen is a casino table, the mouse a lever. Pull it often enough, maybe it pays out. That's not trading. That's slot machines. Here's the sarcastic truth. Amateurs call it intuition. Pros call it what it is. Lack of discipline. Intuition is earned after thousands of trades. Impulse is what happens when your brain's gambling circuitry hijacks your strategy. And let's be clear, your brain loves gambling. Every flashing candle, every tick is designed to trick your limbic system into action. Without a plan, you're not fighting the market. You're fighting your own wiring. And spoiler, your wiring usually wins. So what is a trading plan really? It's not just, I'll buy low, sell high. A plan defines your entry criteria, your stop, your target, your risk per trade, your maximum daily drawdown. It's your guardrail against self-destruction. If you can't write your plan in one page, you don't have a plan. You have a fantasy. And this is where psychology meets math. A good trading plan forces you to define risk-reward up front. 1-to-2, 1-to-3 ratios. That way, even if you lose more than you win, you still come out ahead. Without that structure, you're just winging it. And winging it in the market is like skydiving without a parachute. You don't get many chances to regret it. But here's the motivational angle. The traders who finally build a plan don't just survive, they grow. Because the plan doesn't just manage risk, it manages you. It gives you permission to sit out, to avoid boredom trades, to wait for setups that meet your criteria. And every time you follow it, you're casting a vote for the disciplined trader you want to become. How do you build one? Start with backtesting. Journal your trades. Track not just wins and losses, but the setups that consistently work for you. Maybe breakouts with volume, maybe mean reversion on oversold conditions. Whatever fits your personality. Then codify it. Write, if X and Y happen, I enter. If not, I sit. No exceptions. No, just this once. That's the difference between a hobbyist and a professional. Let me tell you a story. A trader I knew used to enter 5 to 10 trades a day, chasing every flicker. His account was a yo-yo of hope and despair. After blowing up twice, he finally forced himself to only take trades that met 3 strict conditions: trend alignment, volume confirmation, and risk-reward of 1 to 2 or better. Guess what happened? His win rate didn't magically increase, but his losses shrank. His discipline grew. His account stopped bleeding. The plan didn't make him perfect, it made him consistent, and consistency is the only currency that compounds. So here's the tough love professor line. If you don't have a written plan, you're not a trader. You're a gambler with better graphics, and the market eats gamblers for breakfast. But let's not end with despair. The coach in me has to tell you, building a plan is easier than you think. You don't need perfection, you just need parameters. Write your rules, stick to them, and refine them as you go. Trading is not about brilliance, it's about discipline executed over time. So the next time you feel that urge to click without a reason, remember, every impulsive trade is a vote for chaos. Every disciplined trade is a vote for survival. Which version of you do you want the market to see? Because here's the kicker. Even with a plan, many traders still sabotage themselves. They misread the very tools designed to guide them. They turn RSI and MACD into crystal balls, see signals where none exist, and wonder why they bleed. And that's the 4th trap waiting for you. Trap 4. Misinterpreting indicators. If you've ever stared at RSI or MACD like it was the Rosetta Stone, convinced you'd crack the code of the market, you already know how this story ends. Disappointment. The 4th trap is seductive because it feels scientific. You've got lines, histograms, divergences, crosses. It looks technical, professional, precise. But misinterpreting indicators is one of the most expensive habits in trading. Here's the raw truth. RSI doesn't predict reversals. MACD doesn't guarantee momentum. Bollinger Bands don't mean buy low, sell high. Indicators are tools, not oracles, yet most traders treat them like crystal balls. They see RSI dip below 30 and scream, oversold, buy now, only to watch price keep falling like a knife. Or they see a MACD cross and celebrate a confirmed trend right before it collapses. Why does this happen? Psychology. Traders crave certainty. The market offers none. So indicators become comfort blankets. They provide the illusion of control. Look, the line crossed, it must mean something. In reality, the line is just math applied to past data. Past data, not the future. It's a mirror, not a prophecy. Here's the professor's lecture. Indicators lag. By definition, they process old prices. They're summaries, not predictions. A moving average cross doesn't cause a trend. It reflects one that's already happening. Treating indicators as gospel is like driving while only looking in the rearview mirror. You'll eventually crash. And yet here's the dramatic part. Even seasoned traders fall into this trap. Why? Because indicators also feed confirmation bias. If you want to see a bullish setup, you'll interpret every RSI bounce as proof. If you fear missing a move, you'll treat every MACD cross as divine permission. The problem isn't the tool, it's the user. So how do professionals use indicators differently? Context. They don't take signals in isolation. They combine them with volume, price action, market structure. An RSI divergence in the middle of chop is worthless. An RSI divergence at a key support, with strong volume confirmation? Now it means something. The tool is only as sharp as the craftsman. Here's a story. A trader once told me he went broke because of RSI. He had memorized the textbook. Below 30 oversold, above 70 overbought. So he bought every dip below 30. Sometimes it worked, more often it didn't. Why? Because RSI can stay oversold in a strong downtrend for weeks. He was trading the indicator, not the market. The market punished him for it. Contrast that with another trader who used RSI only as a secondary filter. First, he identified the trend. Then he looked for RSI divergences to time entries. He wasn't predicting, he was adding probability. And probability, not certainty, is the real edge. Now let's add some sarcasm. If you really enjoy donating to the market, by all means, keep buying every oversold dip because a YouTube video told you RSI works that way. Keep shorting every overbought level because you think the market must reverse when it gets tired. Just don't be surprised when the whales use your blind faith as liquidity for their real moves. So here's the motivational takeaway. Stop outsourcing your judgment to squiggly lines. Indicators should support your analysis, not replace it. They're like instruments in a cockpit. You still need the pilot's brain. If you can't explain why an indicator is giving you a signal in the context of market structure, you don't have a signal. You have noise. Practical steps? Simplify. Pick 1 or 2 indicators that genuinely help your style. Journal every trade. Did the indicator confirm the setup or mislead you? Over time, you'll learn its strengths and weaknesses. Combine it with volume, price action, and most importantly, patience. Don't let a single flashing signal override your entire plan. Because here's the bigger truth. The trap isn't RSI. It isn't MACD. It isn't Bollinger Bands. The trap is your mind, the part that desperately wants shortcuts, certainty, and easy answers. The pros know this. That's why they treat indicators as assistants, not masters. So the next time your indicator lights up, pause. Ask, is this a signal or just my bias looking for confirmation? That pause could save your account. And now that we've walked through all 4 traps, fake breakouts, stop hunts, impulsive trades, and indicator illusions, it's time to zoom out. Because the real enemy isn't any single trap. It's the psychology that makes you fall for them again and again. And in the next part, we'll bring it all together and reveal how to escape the cycle for good. By now, the pattern should be painfully clear. The 4 traps we've exposed: fake breakouts on low volume, stop hunts by big players, impulsive trades with no plan, and blind faith in indicators are not just technical mistakes. They're psychological landmines. The market doesn't destroy traders because of a lack of tools. It destroys them because of the wiring in their brains. Think about it. Why do traders keep chasing weak breakouts? Because of FOMO. Fear of missing out is the oldest addiction in finance. A green candle pokes above resistance, and suddenly rational thought shuts down. The brain screams, "Get in now or regret forever." It's not analysis. It's panic dressed up as opportunity. And when volume whispers that the move has no support, nobody listens. FOMO drowns everything out. Why do traders keep falling victim to stop hunts? Because of predictability. The human mind craves patterns, safety, obvious zones. So they place stops at textbook levels, believing they're smart. But smart money reads the same textbooks. They know where the herd hides. They know how to trigger pain en masse, and the ego refuses to admit it. After every stop out, retail screams, "Manipulation." But the truth is uglier. It was your predictability that painted the target on your back. Why do traders trade impulsively without a plan? Because boredom is unbearable. The silence between real setups feels like torture. The itch to act overrides the patience to wait. Traders convince themselves that something is better than nothing, but in trading, nothing is often better than something. The casino mindset hijacks discipline, and suddenly the account isn't a portfolio, it's a slot machine. And why do traders misinterpret indicators? Because they crave certainty. They can't handle the chaos of raw price action. They want lines and crosses and signals that tell them what to do. They want prophecy. Indicators become the new religion, the chart their temple. And like all false religions, blind faith ends in disillusionment. RS, I doesn't save you. MACD doesn't protect you. They're mirrors of the past, not windows to the future. Do you see the theme? Every trap is rooted in psychology. Fear, greed, boredom, ego. Even seasoned traders, yes, the ones with decades of experience, fall into these traps. Because no amount of knowledge erases human wiring. The difference is that professionals know how to manage it. Amateurs deny it, and denial is fatal. Let's go professor mode for a moment. Behavioral finance has a whole catalog of biases that map perfectly to trading. Confirmation bias makes you see what you want to see on indicators. Loss aversion makes you hold losers too long, terrified to admit defeat. Gambler's fallacy makes you think, after 3 losses I'm due for a win, so you size up and lose bigger. Overconfidence makes you believe you've figured it out right before the market humbles you. These aren't bugs, they're features of the human brain, and the market exploits them mercilessly. Now the coach in me has to step in. This isn't hopeless. The fact that these traps are psychological means they can be managed, not eliminated. You will always feel fear, greed, boredom, but managed. The great traders didn't become robots. They became observers. They learned to see their impulses before acting on them. They built rules not just for trades, but for themselves. They journaled their emotions. They celebrated discipline even when it meant taking a loss. They turned the traps into teachers. And here's the storyteller's perspective. Imagine the market as a jungle. The traps are everywhere, camouflaged. Most wander in blind, get snared, and never return. A few, though, stumble, bleed, and learn. They start to notice the signs, the rustle in the bushes before a stop hunt, the hollow echo of a low-volume breakout, the addictive itch of an impulsive trade. Over time, their scars become their survival guide, and eventually they stop being prey and start becoming predators, not of other traders, but of their own worst habits. So, let me ask you, how many times have you been caught by these traps? How many times have you sworn, never again, only to repeat the cycle? How many accounts have been sacrificed not because of bad luck, but because you refused to confront the mirror? Here's the paradox. The market doesn't punish you for being wrong. It punishes you for staying wrong. It doesn't punish you for losing. It punishes you for refusing to lose small. It doesn't punish you for using indicators. It punishes you for worshiping them. And once you understand that, the path out of the cycle begins. Because trading mastery isn't about avoiding traps. It's about learning to recognize them and walking differently. It's about turning fear into caution, boredom into patience, ego into humility. It's about realizing the market isn't against you. It's neutral. The real enemy and the real opportunity are both inside you. So as we step into the final chapter, we're going to tie it all together. We'll review the traps, the psychology, the scars, and then we'll look at the way forward. Because this isn't just about avoiding mistakes. It's about transformation. And that's what Part 7 will reveal. How to become the kind of trader who not only spots the traps, but rises above them, consistently, deliberately, and unbreakably. So here we are, the end of the road. We've walked through the 4 most common traps that keep traders bleeding, chasing fake breakouts on weak volume, getting ambushed in stop hunts, clicking impulsively without a plan, and worshiping indicators like they were crystal balls. And if you were paying attention, you noticed the thread tying them all together. It was never really about the charts. It was about you. The market is not your enemy. It's not some evil force out to get you. It's a mirror. It reflects every weakness you refuse to face, your fear of missing out, your hunger to be right, your impatience, your addiction to certainty. These traps work Because they don't just attack your account, they attack your psychology. And unless you confront that, you'll keep walking into the same jaws over and over again. But here's the liberating truth. The very traps that break most traders can build you, if you choose to learn. Every fake breakout teaches patience. Every stop hunt teaches humility. Every impulsive trade teaches discipline. Every false signal teaches skepticism. The market charges tuition. Yes, but the lessons are priceless if you actually study them. The professor in me has to remind you, trading is probability, not prophecy. You will always lose trades. You will always be tempted. You will never outgrow fear or greed, but you can outgrow the control they have over you. That's the difference between the amateur and the professional. The amateur denies emotions. The professional designs around them. The coach in me has to push you. Stop waiting for the perfect system. Stop hunting for gurus to save you. Stop blaming whales, news, or algorithms. The only thing you control in this game is yourself, your plan, your discipline, your response. That's where freedom begins. And once you realize that, you stop being the hunted and start becoming untouchable. And the storyteller in me has to paint this final image. Imagine two traders standing before the same chart. One sees opportunity and jumps impulsively, fueled by hope and fear. The other waits, measures, follows rules, and acts with calm. The market doesn't care who they are, but in time, one bleeds out, and one survives. The difference was never the chart. It was the character they brought to it. So, let me ask you one last time. How many more traps will you fall into before you decide to change? How many times will you call it bad luck before you admit it was just bad psychology? How many more donations will you make to the market gods before you realize the only real battle is the one inside you? The choice is yours. You can keep chasing candles, blaming manipulation, and worshiping indicators, or you can step up, write a plan, manage your risk, study your emotions, and trade like someone who intends to survive. Because survival is the only path to mastery, and mastery is the only path to freedom. In the end, trading isn't about beating the market. It's about beating the version of yourself that keeps falling into traps. And if you can do that, if you can walk past the bait, resist the panic, and trust your process, then the market has nothing left to take from you. Remember this, your next trade isn't just a position, it's a decision about who you are becoming. And once you start choosing differently, the traps no longer own you. The market will still test you. It will still tempt you. It will still lay its snares, but you won't be prey anymore. You'll be the trader who sees the trap, smiles, and walks right past it. Because at that moment, you're no longer trading just for profit. You're trading for identity. And the market cannot defeat a trader who has already defeated themselves.